Right, so you see here, the chapter we are working on this week is building blocks of managerial accounting. So again, we're just going to do a quick review of what we covered the other day. We looked at the difference between different types of organizations, right? But they all use managerial accounting, whether they are merchandisers, manufacturers, or service companies, right? And a merchandiser is a what? Retailer? Okay. We see that there are some differences in the accounting, not huge differences, but for example, a service company is not going to have a cost of goods sold because they're not selling a good, right? Whereas a manufacturing company or merchandising company does sell a physical product. We looked at how, income statements, we're familiar with those already. We looked at how to calculate cost of goods sold though, right? If you didn't have that information, how would you figure out cost of goods sold? And we learned that there's a pretty simple formula where you take your beginning inventory, now this is for a retailer, add any purchases that you made during the period, subtract how much inventory you have left over at the end of the period, and that tells you the cost of the inventory that you sold, right? But we also learned that for manufacturers, it's more complicated because for a manufacturer, you do the same thing, but you have to calculate the cost of manufacturing goods. Laura, make sure you put your name there, right? And there are many steps involved with calculating the manufacturing costs. For example, you have to start with what is your current work in process inventory? Now, there are 3 phases of inventory. You have finished goods, right? Those are products ready to be sold. We have work in process, which means there are products we're making, but they're not done yet. And the earliest stage is raw materials, right? So those are all inventory, but just at different stages. So here, to figure out the cost of what we manufactured during the period, we have to start with our work in process inventory, add all of our manufacturing costs from that period, subtract our ending work in process inventory, and that tells us the cost of what we manufactured, right? And these manufacturing costs that we incurred during the period have 3 parts. We see those 3 parts right here. We've got our direct materials, our direct labor, God bless you, and our manufacturing overhead, right? But then where do we get the direct material costs, right? So we need a schedule for our direct materials as well. It's a similar formula. We start with the beginning materials. So how much raw material we had at the beginning of the period, plus how much material we purchased, minus how much we still have left over at the end of the period, and that tells us the cost of the materials that we used in production.
Mr. Williams, for direct labor, is that just payroll or does it include other stuff?
It does include benefits paid to the hourly workers when they are directly working on the product. It gets a little complicated. Fortunately, we don't have to get into that much detail, but you will see some examples later where even the benefits paid for direct labor are included in the direct labor cost. So it's the wages and the benefits. But those same hourly workers, when they're not making a product, when they're doing training or maintenance or something like that, then their labor falls into a different category and their benefits fall into a different category. And what is that other category that's not direct labor? Indirect labor, right? So fortunately, we don't have to get into that in this class, but people who process payroll might have to track how many of the hours were direct and how many were indirect based on the time cards, and then even divide up the benefits between those 2 different categories. So yeah, we would also have to calculate the labor and the overhead, add that all in here, right? So that gets a little tricky. So, and then here we see how they all fit together, right? From the schedule of materials, we get the direct materials used in production. That becomes part of this calculation. That gives us cost of goods manufactured. But not every good that was manufactured was sold. So that becomes part of this calculation, and we can figure out the cost of the goods that we actually sold, which becomes part of our income statement. Right? Easy breezy. So again, we saw examples of that. We don't need to go through that again. We looked at a service company income statement. We did some of the exercises and problems. Okay, we talked about fixed versus variable. Let's review that. So total fixed costs, do they vary based on production? No, they stay the same, right? Total variable costs, do they vary based on production? Yes, that's why they're called variable costs, right? That's the easy part. So if you just remember that, that's going to be really helpful. And then where it gets tricky is when we start talking about cost per unit, because then it's the opposite. Fixed costs per unit go down the more you produce. What happens with variable costs per unit when production changes? Stay the same, right? Variable costs per unit stay the same. So try to remember that because that's going to keep coming up over and over, not only in this chapter, but in future chapters. We looked at this hotel example that had the fixed and the variable costs. And we saw how the fixed cost, again, this is the total fixed cost, stayed the same, regardless of how many units they rented out, right? But the variable cost goes up based on how many units, how many rooms. And then when you add them together, the total cost, which is the fixed plus the variable, starts here, right? Because even if they rent out 0 rooms, they still have $2,000 of costs. And then it just goes up parallel to the variable cost line. Right? Are there any questions on anything so far? All right, so this is the formula to figure out your fixed costs per unit and your variable costs per unit. Okay? Even though they're calling it average fixed cost and average variable cost, for the rest of the textbook, they don't use those terms. And I don't use those terms. So to get your fixed cost per unit, you take your total fixed costs and divide by the number of units. Right? And if you're good at thinking algebraically, that means you could also take your fixed cost per unit, multiply it by the number of units, and that would give you your total fixed costs, right? So you could kind of work backwards. Same thing down here. Total variable cost divided by the number of units gives you your variable cost per unit, and you can go the other way. You can multiply your variable cost per unit times the number of units to get your total variable cost, right? Okay. Make sure you put your name on the list. Yeah. There's no pen there? Okay. Right. Well, I have one. You got one? Okay. Right. I took my pen. It was getting low anyways. Okay. So here's an example. We see for this company, if they have fixed costs of $1,000 a month for rent, you can divide that by their units produced, and you get their fixed cost per unit, right? And we see how it goes down as their production goes up, right? On the other hand, variable cost per unit, we know stay the same. And when you multiply them by the number of units produced, as the number of units goes up, your total variable cost goes up. All right, anything need clarification? Any questions? All right, great. So we did that. Let's see. Oh yeah, you remember that one. That took us a little while. We talked about mixed costs, right? That's when there are both fixed and variable costs associated with one particular thing. And there are three ways to estimate what mixed costs are going to be. Two of them involve spreadsheets. That would be the scatter graph and linear regression. But we're not going to be doing those in class. We'll look at some scatter graphs, but we will be using the high-low method. We walked through that a little bit. It's a multi-step process, so don't worry. If you didn't quite get it, we'll be going through that once or twice again today. This is just an illustration of what mixed costs are, having both fixed and variable components. We talked about step costs. What is a step cost? When your mom marries another cost. What's a step cost? Yeah, fixed costs. Yeah, it's when your fixed costs jump up, for example, because you hired another supervisor or you rented an additional factory. So costs were fixed, but for some reason, it jumped up to a new amount. Okay. And so it looks like that, right? If you were to chart it out. So we also talked about the difference between product and period costs. Product costs obviously have to do with production, right? Anything involved with making a product, even if it's indirect labor or indirect materials, but that's still part of the production process. Okay, so anything related to a factory would fall into product costs. All costs in a company are either product costs or period costs. I mean, there might be some exceptions, but I can't think of any. So basically we have product and period. What is a period cost? Not a product cost, right? It's everything else. And why do we call it a period cost? Alexandra? I thought you were going to say something.
Because they are expense in the period in which they occur.
Yeah, perfect. Well said. They are expensed in the period in which they occur or are incurred. So anything that's not product related, whenever that expense happens, we count it in that period and we call it a period cost. But why don't we do that with production costs? Why don't we just count those expenses in the same period that we made the product? Remember in financial accounting, learning about the expense recognition principle that says you can only count an expense, a production-related expense, when there is revenue to be associated with it. So we can only count our inventory costs as expenses once we've sold the product. So we might have made the product last year, but it's sitting on our books as inventory, as an asset, until we sell it. And at that point, that becomes an expense, cost of goods sold, right? So that's the big difference. Product costs are not counted as expenses until the product is sold. And period costs are counted in the period that they occurred. All right? Okay. We looked at a couple journal entries. For example, this is an illustration of what I just said. When you sell a product, it's no longer part of your inventory. So that asset gets credited because you don't have it anymore, right? The asset has decreased on your books. But you now have cost of goods sold, and we debit it. Why would we debit cost of goods sold? What type of account is it? Expense is right. So it's going from being an asset when it's in our inventory to an expense once we've sold that product. Right? Okay. And a similar thing happens here. Prepaid insurance goes from being an asset until time has passed and that insurance has expired. And at that time, it becomes an insurance expense. Then we get to prime and conversion costs, and these relate only to production costs, okay? And the three types of production costs were what? What are the three elements of our production costs?
Direct materials, direct labor, and manufacturing overhead.
Okay, direct materials, direct labor, and manufacturing overhead, that's exactly right. And we see here that the prime costs are the direct materials and the direct labor, right? Prime, really just means first. So those are the first costs. When you're producing, you take your materials, you start adding some human labor and turning it into a product, right? So the prime costs are just that portion and not including the overhead, because overhead, you can never actually even calculate what the overhead costs are until after the fact, until after the product's already completed. So prime costs is the first two. Now conversion costs tell us what does it cost to convert that raw material into a finished good, right? And the way you convert a raw material into a finished good is you add labor and you add overhead. I think you just came in. Did you put your name on? Yeah. Okay, great. All right, so is that all clear so far? And we went through this exercise. I think this was the last slide we got to here in the lecture to test out our knowledge. We're going to have, I think there's a problem we're going to go through that's going to be similar. We'll check and see how well we understand these concepts. Oh, in fact, this is it. Nice segue, Trav. So yeah, we're going to do this problem number 4 right now. I'll pause the recording. Starting at the top, let me get everybody's attention. Okay, so excuse me. So for A, is it a fixed or variable cost?
Fixed.
Okay, that is right. Salaries tells us it's a fixed cost. And is it product or period? Correct. Because it's administrative staff, so that would make it period. Okay. Shipping costs on merchandise sold. It is variable. Now, in this case, it's not varied based on how much we produce. It's variable based on how much we sold, but it would still be considered variable. And is it a product cost or period cost? Actually, period. Yeah. Because shipping is after production. Yeah. So it's not considered a production cost. Wages of workers assembling computers. What do you say?
Variable.
Variable and product is right. Okay. Cost of lease on factory equipment. Fixed and product, because it's the factory equipment which is involved in production. Okay. Insurance on the factory. Yes, and product or period? Same thing, it's insurance on the factory, so it's a product related cost. Okay, anything to do with the factory or production falls under that production category. Yes,
Does
Jahara.
it matter what type of factory it is, or as long as the factory is?
A factory
considered a
produces things, so any factory would be product related. Yep. All right, F, direct materials used in production of lamps.
Variable.
And product. Yes, that is right. Variable and product. G, no, yes, G, supervisor salary factory.
Fixed product.
Fixed and product, yes. And H, advertising costs.
Variable.
Fixed.
How many people say variable? How many people say fixed? So fixed is right, right? Advertising does not depend on how much you produce. It doesn't depend on how much you sell. It's kind of the opposite. How much you sell kind of depends on how much you advertise. So when a company establishes an advertising budget, that's generally a fixed amount. So it is fixed and product or period. Period is right, yes, because it's not part of production. Property taxes on the factory. Okay, those would be fixed. And product, exactly. Health insurance cost for company executives.
Fixed period.
Fixed period is right. And last one, rent on the factory.
Fixed product.
Fixed product. Okay. Very good. I'm going to pause. Okay, so let's go through this scenario together. We have a person named Margot planning a trip. And you'll see there are fixed and variable costs involved in this trip. It's an 8-day trip. And she's planning to rent a condo on the beach. The condo can accommodate 7 adults, okay? They're planning to take an SUV that can carry up to 6 people and luggage. They're anticipating 20 miles per gallon, 1,250 miles round trip. You see the cost of gas. The people on the trip will need a season pass for an amusement park. That's $168 per person. And then they're estimating $40 per person for food, okay? So the items in bold are the important pieces of information we need. And we see a summary down here, okay? Drives me crazy. I don't know why it does this. Okay. So if we go ahead and put that into a table, because Margot is just a very analytical person, and we would get something like this. So the number of people going, including Margot, well, this would be her going by herself, or we have up to a total of 6 people on the trip, right? So the average variable cost or variable cost per person is $208. Let's see where that comes from. We've got the food per person per day. Wait a minute, that's per day. It's just no, it's an 8-day trip. Never caught that before. Okay. So just pretend that's the food for the whole 8 days. Okay, which I know doesn't sound right, but I'll have to fix that. So the food plus the amusement park, right? Those are variable because the more people that go on that trip, the more that cost is going to be, right? So if we take a $40 food cost and $168 season pass for each person, that's $208. So you multiply that by the number of people going, and we see that for 2 people, it's double, 416, and that total variable cost continues to increase depending on the number of people going on the trip. Okay, does that make sense so far? Then the fixed costs, let's take a look at those. We've got the rental of the condo. We have the gasoline. So in this case, because we've already calculated how much gas cost there's going to be for the trip, it really doesn't matter how many people are in the vehicle. Now you could argue that that increases the weight. Maybe we use a little more gasoline with more people, but okay, let's not get into that level of detail. So in general, whether it's 1 person going in the SUV or 6, the gasoline, we'll say, is the same price, okay? And you add the condo rental, which is the same regardless of how many people are going. So those are going to be fixed costs. We see that those stay the same regardless of how many people are on the trip. But the average fixed cost goes down depending on the number of people, right? And what was that formula to calculate the average fixed cost or the fixed cost per unit? How do you calculate it?
It was the
Total cost of it.
Yep, the total fixed cost divided by the number of units, and in this case, a unit is a person, right? If we take the total fixed cost, like here, divided by the number of people, we get a fixed cost per person or unit. All right, and then if we add the variable cost plus the fixed cost, is that right? Fixed cost, the total variable cost plus total fixed cost. Okay, sorry. I made this table, by the way. I might have messed it up. Let me think. Average cost per person. So we have the fixed cost plus the variable cost. Okay, that makes sense. And here we have the average fixed cost plus the average variable cost. That would be.
The first one's also the average variable
Oh, that's
cost, plus
right.
the average fixed cost.
Average variable cost of 208 plus 794 equals 1,002, right? Okay. Okay, so hopefully that math is right throughout there. But if we take the average variable cost and the average fixed cost, we get an average cost per person. Total cost per person, okay? So this is helpful to have this information, but now we have some questions. What additional costs would be included if a seventh girl was invited on the trip? So let's think about that. Based on what we know, what additional cost would there be with another person?
that girl would probably have to rent out her own car or rent out a bigger car.
Exactly. The SUV only holds 6, so there's going to be an additional transportation cost, right? And then, of course, the variable cost would also go up. Right? More food and another season pass. But the condo accommodates stuff, so we'd still be okay as far as the condo goes. And which cost would not be affected? Well, the condo. Okay. So you see how these principles apply and how they could be helpful in decision making and planning. All right, any questions there? All right, what are the total variable costs for the trip? So again, it's going to depend on how many people, right? But we have a column that tells us total variable costs. What are, did she decide how many? Okay, she decided to have a total of 6 people on the trip. So let's answer it based on 6 people. Total variable cost then would be this, right? $208 per person times 6 people. And then average variable costs, well, that's the same, right? Regardless of how many people. So we know the variable cost per person is $208. And then we have total fixed cost for the trip. So based on 6 people, total fixed cost is going to be, all right, total fixed cost $1,588. Yes, because we're only talking about fixed costs. Yes, that's correct. And average fixed costs comes out to $265 per person, right? Because it's being divided by 6. And what would the, average cost per person, I skipped that one. The average cost per person comes out to $473. So you see that's a lot better for everybody than if anybody went by themselves. And if Margot did go by herself, she's looking at $1,800. No wonder she wants to invite as many friends as she can, right? Okay. Any questions or comments? Problem 5, okay, so let's work on that one next. Oh. Forgot to turn my camera on. That was another reason I wasn't going to record these, but because I knew I would forget. Okay, I'm going to pause. All right, so here we actually did talk about this a bit on Tuesday. I don't imagine it completely sank in. Is that the right grammar? Sank in. So this is the high-low method that we can use to estimate mixed costs. So if you're given some costs that are a mixture of fixed and variable, you don't know how much is fixed and how much is variable, it would seem difficult to be able to then project and estimate how those costs would change based on different levels of production because you don't know how much is fixed and how much is variable. But the way we do it is with this formula. So the textbook says Y, which represents total costs, equals A, which is fixed costs, plus B, which is variable cost per unit, times X, which is the number of units. Okay? So the total cost equals the fixed cost plus the variable cost per unit times the number of units. And that makes sense, right? Okay. Now, here we see an example of how we could apply that formula if we knew that total cost equals a fixed cost of $125,000 plus a variable cost of $70 per unit times the number of units. And whatever the number of units is, we can estimate what that mixed cost would come out to, right? And so we see in this example, 3 different levels of production and the estimated total costs based on the formula. But the tricky part is if you don't know what the fixed cost is and what the variable cost per unit is, how do you figure that out? So you're gonna have to wait for the answer because it's coming on a different slide. This is kind of the same concept though. Let's take a look at this example. This is based on 1,000 units of production. Yes, so these are based on 1,000 units of production. If the company doubled its production to 2,000 units, would the fixed salaries change if production doubled? No, because they're fixed, right? So it doesn't matter how much we produce. How about lumber, the variable cost? If it was $75,000 in March and we doubled our production in May, would that go up?
Yes.
Yes, it would double, right? Now, production worker wages, here it tells us the hourly rate. Well, that hourly rate would stay the same. We need to know the number of hours to then figure out what's the total variable cost, right? But the cost per hour would stay the same. How about maintaining the machine? If it costs $5 per unit to maintain the machine and we double the number of units, is that going to increase our maintenance costs?
Yeah. Yes.
Right. And last one, the lease on the factory is fixed, so production could change, but the lease stays the same, right? Okay. Did we do this one? I think we did, didn't we? Number 6. Yes, yes, we did this one, right? Service company based on the number of clients. Yeah, we did that. Okay. So I'm not gonna do it again. Unless you want to. Anybody want to go back over that one? Okay, so again, the high-low method is what we are going to be focusing on. The scatter graph method, you don't have to use a spreadsheet. You could just take a piece of paper and make your own scatter graph, but there is a way to do it on spreadsheets as well, where you put the data in and it makes the graph for you. And we'll see what that looks like. But this could be used to estimate mixed costs at different level of production. And then least squares regression is something you would do with a spreadsheet, because the math is pretty complicated on that, from what I understand. It has to do the statistical analysis, and you could also use that. That would be the most accurate way to estimate mixed costs at different levels of production. But we're going to focus on the high-low method. So I've walked us through it with one example, but let's take a look at this one here. We've got 6 different months, and this company has varying levels of flight hours. So that is their units of production. And they have maintenance costs, which are mixed, okay? So the high-low method starts by selecting 2 months, the highest month and the lowest month, okay? What is our highest month of either activity or costs?
February,
Okay, February, and the lowest month
May.
is May. Okay, so what we need is the costs and the activity level for each of those 2 months. Then what we're going to do is there's a formula we plug them into. Oh, okay, we're not there yet. Okay, that we'll get to in a little bit. Okay, this is a scatter graph. So taking those 6 months and then plotting them on this graph, where flight hours is the x-axis and maintenance costs is the y-axis, right? So for example, we said February was the highest month and May was the lowest month, is that right? So May has 10,000 flight hours and a cost of 64,500. So we see 10,000 flight hours. So that's May right there, and see how the cost is 64,500. So we're plotting each month by the number of flight hours and the cost. And what we get is these 6 dots that make not a perfect line, but pretty close. And that tells us that there is definitely correlation. As number of flight hours goes up, cost goes up. The closer the numbers are to the line, the more perfect that correlation is, and the easier it would be to estimate what the cost would be at different levels. So for example, if we had 5,000 flight hours, we could just look on this line and say, okay, it would be right here around 50,000 or whatever that would come out to. Right? So that'd be one way to estimate our costs. Or if we had flight hours up here, we would just have to see what point that line extends to and then come across to see what the cost would be. So that's how you could use a scatter graph to estimate your mixed costs fairly accurately, okay? And here's the same data again. Here we see the high month and the low month, right? And here's the formula that I mentioned. So what we have to do once we take the high month and the low month, we take the difference in cost between the 2 months and divide it by the difference in the activity or production, whatever it is. And in this case, the high month had $90,000 of costs. The low month had $64,500 in costs, right? So we just subtract to get the difference. And the activity for February was 23 hours and May was 10,000 hours. So the difference is 13,000 hours, okay? You take that difference in cost, divide it by the difference in activity, and we get the variable cost per unit of activity. So in this case, it's $1.96 of variable cost for every flight hour. we were able to extrapolate that out of these mixed costs. I don't know who came up with this, but I think that's pretty brilliant. All right, well, that's great, but we still don't know the fixed cost. And in order to have that complete formula so that we can estimate, we need to know not only the variable cost per unit, which we have right here, we also need to know our fixed cost. Audrey, do you remember you figured out how to figure out the fixed cost? Remember what you said?
By these units,
Yep,
and then whatever that.
exactly right. So now that we know the variable cost per unit, we could multiply it, let's say by 10,000 hours, if we want to use the May data. And then we know the total variable costs for May. We could then subtract the total variable cost for May from the total cost for May. And then we know what portion is the fixed cost. And let's say we wanted to try February. We could do the same thing. Take the variable cost per unit, multiply it by the number of hours in February, the number of units, find out the total variable costs for February, subtract that from the total cost in February, and again, that will give us the fixed cost, and it will be the same number. Whichever month we use, we're going to come up with the same variable cost, because again, they stay the same. Okay? So that's what's happening here. We're taking the variable cost per unit that we calculated, multiplying it, in this case, by February's 23,000 hours, subtracting that total from the total cost of February, and that leaves us with the fixed cost. And now we can have a complete formula. We can say that the total cost is always going to be this fixed cost that we just figured out times the variable cost per unit times the number of units that we're trying to estimate cost for. And that's how you do the high-low method of estimating mixed costs. All right, so it's a multi-step process. We will go through it at least one more time today, so make sure you've written down the steps or you know where to find them in the book, so that if you encounter, I don't know if there's one that you're going to have to do on your own, but just in case, be prepared in case you have to calculate one on your own. Any questions? Okay. All right, so using the formula we had just come up with, we could say if there were 20,000 hours, we would take our fixed costs, which we see always stay the same. We would take the variable cost per unit times the number of units to get the total variable cost, add fixed plus variable, and we get our total cost, right? So we can apply this formula for any level of production. We haven't done this one yet, right? So maybe let's do exercise 11. This does use the same method, but it's a fairly simple exercise. Okay. Oh, actually, no. So, yeah, $480 is 1 month's cost and $320 is the other month's cost, right? So the difference comes out to what? $160 is, sorry. Try that again. $160 is our difference in costs. And what is our difference in production? That is 4,000, right? It's the 9,000 copies minus the 5,000 copies. The difference in cost divided by the difference in production. And when we do that, what do we get? 0.04. That means our variable cost per unit or our cost per copy is 4 cents. Now, in this case, we don't have to figure out the fixed costs. But if we wanted to, we could. We could take 4 cents, multiply it by 9,000 copies, subtract that from the total cost of $480, and that would tell us the fixed cost.
120.
Or we could do it over here. We could take the 4 cents times 5,000 copies, subtract it from the total cost of that month, and we would get the same answer, right? So either way, that will tell us the fixed costs. Okay, are there any questions on exercise 11? Sure, okay. Well then, ooh, we are at the end of the chapter. What do you know? Okay, well, I'll just stand here then instead of moving my camera. Let's see, we learned that all organizations use managerial accounting, right? And that they all pretty much, are going to have similar sorts of income statements, but there are some differences where cost of goods sold shows up for manufacturing and merchandising companies. And we learned that the manufacturing cost of goods sold is not that easy to calculate, right? Because it depends on information, that depends on other information, that depends on your raw material costs. So let's see. I kind of mentioned that. We learned the difference between fixed and variable costs, and that fixed costs, total fixed costs stay the same regardless of production. Total variable costs vary based on production, right? We also learned about mixed costs, which are a combination of fixed and variable. Step costs, which are fixed costs that jump up at certain levels. And we learned about prime and conversion. What is the difference between prime costs and conversion costs? Okay, manufacturing overhead. Let's elaborate. So how do they differ? What's that? Okay, prime is the first cost, and so it includes what? Direct material and direct labors, and then the conversion costs include what? Direct labor and manufacturing overhead. Perfect. All right. Good group work, everybody. We also learned that to predict future costs that are mixed, we can use scatter graphs. We could use the high-low method, and we could use the least squares regression method with the spreadsheet, which would be the most accurate method. So that is it. That is our chapter. Any questions at this point?